Imagine a giant farmer's market, not for apples or tomatoes, but for tiny pieces of companies. That's basically what the stock market is. Let's say someone starts a burger chain. At first, it's just one restaurant. The owner needs money to expand. They could borrow from a bank, but there's another option. They split the company into millions of little pieces called shares and sell them to the public. When you buy one of those shares, you now own a microscopic slice of that business. If the burger chain grows from one location to 1,000, that slice becomes more valuable. More restaurants, more profit, more demand for the stock. If the company screws up and people stop eating there, the slice becomes less valuable. The stock market is simply the place where people constantly buy and sell those slices. Prices move because buyers and sellers are constantly negotiating, not with words, but with money. If people think a company will make a lot of money in the future, they rush to buy shares. If they think the future looks ugly, they rush to sell. The price you see on the screen is just the last price someone agreed to pay. Now here's where things get interesting. The stock market isn't just about companies raising money. Most trading happens between investors. Imagine you bought shares of that burger company 5 years ago. Today, someone else thinks it's a great investment, so they buy your shares. The company doesn't get that money, you do. The market is basically a giant secondary marketplace where ownership keeps changing hands. And that brings us to something people misunderstand all the time: valuation. When people say a company is worth $1 trillion, that doesn't mean there's a vault somewhere with $1 trillion inside. It simply means the current share price multiplied by all the shares equals $1 trillion. If the last share sold for $100 and there are 10 billion shares, congratulations. The company is now worth $1 trillion on paper. That number can move fast because it's built on expectations. If investors suddenly believe the company's future will be huge, the price climbs. If confidence disappears, it can collapse just as quickly. The underlying business might not change overnight, but expectations definitely do. Stocks are just one way companies raise money. Another way is through bonds. A bond is basically a loan. Instead of selling ownership, a company or government borrows money from investors and promises to pay it back with interest. When you buy a bond, you're not an owner. You're the lender. It's more like being the bank than being the shareholder. Because bonds are loans, they usually pay predictable interest. Stocks don't promise anything. You only win if the company grows, pays dividends, or if someone later buys your shares at a higher price. Now here's where things get modern. Most people today don't sit around picking individual stocks. Instead, they buy funds. A fund is just a basket of many stocks bundled together. An index fund is the simplest version. Instead of trying to guess which companies will win, it just buys the entire market. If the index tracks the 500 biggest companies in America, the fund simply owns all of them in the same proportion. No genius stock picking required. An ETF works almost the same way, except it trades on the stock market like a normal stock. So instead of buying shares of one company, you might be buying tiny pieces of hundreds or even thousands of companies at once. This is why people joke that when you buy an S&P 500 ETF, you're basically buying a slice of America itself. Tech companies, banks, energy firms, retailers, airlines. If the overall economy grows, the value of that basket tends to grow too. So when people say the market went up today, what they really mean is that millions of investors around the world looked at the future and decided companies are probably worth a little more than they were yesterday.